Headlines often focus on military deployments and rising tensions. We see images of naval vessels and hear reports of diplomatic standoffs. But beneath the surface of these geopolitical maneuvers, a deeper story is unfolding in this strategic waterway. It's an economic story, a story about energy, security, market stability, and financial risk. What happens here doesn't just stay here. The ripple effects can influence fuel prices, stock markets, and economic expectations in capitals and households thousands of miles away. This isn't just about naval power. It's about the economic currents that shape our world. Throughout history, certain geographic locations have held a disproportionate influence over global systems. In the age of sail, it was control of trade winds and safe harbors. Today, in our deeply interconnected global economy, that influence is concentrated in narrow maritime passages. These are the strategic choke points, the arteries through which the lifeblood of global commerce flows. Think of the Strait of Hormuz, the slender channel through which nearly a fifth of the world's daily oil supply passes. A disruption there could send shockwaves through the global energy market. Or consider the Suez Canal, the man-made marvel that shaves thousands of miles and weeks of travel time off the journey between Asia and Europe. When the container ship Ever Given became lodged in its banks in 2021, it caused a traffic jam of hundreds of vessels, holding up an estimated $9.6 billion in trade for each day it was blocked. Further east, the Strait of Malacca serves as the primary shipping lane between the Indian and Pacific Oceans, a critical conduit for trade with China, Japan, and South Korea. These are not just lines on a map. They are points of immense leverage and vulnerability. Control, or even the threat of disruption, in these choke points gives any actor enormous power to shape supply chains, dictate terms, and influence market dynamics on a global scale. The geography of these passages is, in effect, the geography of power. Markets are creatures of information and expectation. They react not just to what has happened, but to the perceived probability of what might happen. In the context of a strategic waterway, this means that the mere presence of risk can be as impactful as an actual disruption. The financial world quantifies this uncertainty in several ways. Look at oil futures markets. When tensions rise in a critical oil transit region, you'll see the price of future delivery contracts climb. This isn't because supply has been cut, but because traders are pricing in the increased risk of a future disruption. They are buying insurance, in a sense, against a potential shortage. This is often called a risk premium. Similarly, the cost of insuring the massive tankers and cargo ships that traverse these routes skyrockets. Maritime insurance premiums are a direct barometer of perceived danger. Insurers, like Lloyd's of London, will designate certain areas as listed areas or war risk zones, requiring vessels to pay substantial additional premiums to obtain coverage. These higher costs are, of course, passed down the supply chain. Beyond commodities and shipping, the broader stock markets also react. The shares of energy companies may rise in anticipation of higher profits, while airlines, which are heavily dependent on fuel costs, may see their stock prices fall. Uncertainty is poison to market stability. Even without a single shot being fired, the shadow of potential conflict can redirect capital, alter investment strategies, and inject a volatile element of fear into global economic calculations. For most people, the complex world of futures markets and insurance premiums feels distant. But the impact of instability in a strategic waterway inevitably finds its way into our daily lives. The most immediate and visible connection is at the gas pump. Since crude oil is the primary input for gasoline and diesel, any increase in its price, whether from actual shortages or risk premiums, translates directly to higher fuel costs. This isn't just an inconvenience, it's a tax on mobility. It costs more to drive to work, to take children to school, and for delivery trucks to bring goods to stores. This leads to the second-order effect, the price of almost everything else. Farmers use diesel to power their tractors and transport produce. Manufacturers rely on energy to run their factories. Retailers depend on trucking to stock their shelves. As transportation and production costs rise, businesses face a choice: absorb the costs and reduce their profit margins, or pass them on to consumers in the form of higher prices. More often than not, it's the consumer who pays. A sustained period of high energy prices can ripple through the economy, showing up in more expensive groceries, higher utility bills, and increased prices for manufactured goods. This broad-based inflation erodes purchasing power, forcing households to make difficult financial decisions. Vacations may be postponed, savings goals may be missed, and discretionary spending shrinks, potentially slowing down the entire economy. A geopolitical event in a faraway strait can ultimately determine the balance of a family's monthly budget. The immense economic stakes involved mean that nations with significant exposure to these energy flows engage in complex strategic calculations. It's a delicate balancing act between protecting economic stability and asserting national interests. The United States, for decades, has implicitly underwritten the security of global maritime trade, particularly in the Persian Gulf. Its naval presence has been aimed at ensuring the free flow of oil. not just for its own consumption, but for the stability of the entire global economy, upon which its own prosperity depends. This role as a global security provider, however, comes with enormous costs and political complexities. Meanwhile, a rising power like China is acutely aware of its own vulnerabilities. It is the world's largest importer of crude oil, and a significant portion of that supply travels through chokepoints like the Strait of Malacca and the South China Sea. This dependency, sometimes called the Malacca Dilemma, drives much of China's foreign policy. From its Belt and Road Initiative, which seeks to create alternative land-based routes, to its assertive naval expansion aimed at securing its maritime supply lines. Then there are the major oil-exporting nations themselves. Their economic health is directly tied to their ability to get their primary product to market safely and reliably. For them, regional stability is paramount. But this desire for stability is often intertwined with their own geopolitical rivalries and strategic ambitions, creating a web of alliances and tensions that can be incredibly fragile. These overlapping and often conflicting interests create a dynamic and unpredictable environment where security considerations and economic priorities are in constant interaction. So, what are the potential outcomes when tensions flare in a critical waterway? We can imagine several scenarios, each with different economic consequences. In one scenario, we might see a short-term, limited disruption, perhaps a temporary blockade, a maritime incident, or an attack on a single vessel. This would likely cause an immediate and sharp spike in oil prices and insurance premiums. Markets would react with high volatility as traders try to assess the duration and severity of the disruption. However, if the situation is resolved quickly through diplomatic means or a limited military response, prices might fall back just as quickly, though likely settling at a slightly higher baseline due to the lingering risk. A second, more serious scenario would involve a prolonged period of disruption. This could be a sustained blockade or a wider regional conflict that makes transit through the waterway untenable for an extended period. In this case, we would see a structural shift in global energy flows. Shipping companies would be forced to reroute vessels, taking longer and far more expensive routes, for example, around the Cape of Good Hope instead of through the Suez Canal. This would create significant and sustained upward pressure on energy prices and widespread supply chain chaos. Inflation would become a major global concern, potentially triggering economic recessions in import-dependent nations. A third scenario involves not a complete disruption, but a long-term strategic realignment. This is a slower, more gradual process where countries actively reduce their dependency on a particular choke point by investing in pipelines, developing alternative energy sources, and shifting trade patterns. While this might enhance long-term security, it also involves massive investment and can redraw the economic and geopolitical map over decades. The reality is that these scenarios are not mutually exclusive. We could see short-term volatility coexisting with longer-term structural adjustments, reflecting the deeply interconnected nature of our globalized world. The events unfolding in this strategic corridor are a powerful illustration of how geography can shape economic reality. The narrow passages of the sea, the flow of tankers, the calculations of traders in London and New York, and the price of gasoline in your hometown are all part of the same intricate system. Understanding these connections provides a vital context for interpreting global developments. It allows us to look beyond the military headlines and see the powerful economic undercurrents that drive decisions, influence markets, and ultimately, shape our lives. Thank you for watching. If you found this analysis insightful, please consider subscribing for more deep dives into the forces that shape our world.